Welcome to our presentation on Article 12, which is Royalties and Fee for Technical Services. Now, when you talk about Article 12, it's not necessary that royalties and fee for technical services will always be Article 12. Depending on which treaty you are looking at, the number of article may be different. But there are two distinct things which are covered as a part of Article 12, right? The first one is royalties, right? And the second one is fee for technical services. Now, these two are actually different terms meant to cover different type of receipts. In some of the treaties, you may find that only royalties is there. In some of the other treaties, you may find both royalty and fee for technical services is there, right? And in some other treaty, you may find that neither of them are there. Depending on that, you see whether or not Article 12 is applicable. So like I said, let's understand what Article 12 covers. There are basically two topics which are covered as a part of Article 12. The first one is royalty. Now, royalty, if you see, is technically a payment which is made for the use of an asset. That asset might be a tangible asset, such as an equipment, or it could be an intangible, something like a brand or a patent or a trademark, and many other intangibles which are there, right? The next one is fee for technical services. Again, like the word itself includes the word services, basically a fee for technical services is a payment which is made for services as against royalty which is made for the use of an asset. Now, while the name says fee for technical services, the services which are included may not necessarily be all technical. It generally includes managerial services, technical services, or consultancy services. This article, while in most of the treaties is known as fee for technical services, it may also be called as fee for included services, something what you have in the India-US treaty. It may also be called fee for technical and professional services. In fact, in some of the treaties, it is also referred to as fee for management services. But the nomenclature of the article itself is only a guide to the interpretation of the article in a treaty. Ultimately, what matters is what are the content of that particular article. And seldom you will find two treaties which will be having everything in the same context, right? So what is important, the point I'm trying to drive home here is that every time you read a particular article, you should see what are the constituent of that article. So let us look at what are the key learning objectives of this presentation. And we'll go through them one by one. This is basically going to give you an insight in terms of what you are spending your time on and whether it is covering what you require. The first thing is how to determine the taxability and interplay of the Act and treaty. So now, as you know, and I'm sure you must be knowing about this, but even for people who do not know, a non-resident has an option to be taxed as per the provision of the Income Tax Act 1961 or the tax treaty, whichever are more beneficial to him. So we are going to see how a royalty or an FTS is going to be taxed under the Income Tax Act and under the treaty. The second is, what is the meaning of royalties and fee for technical services? Like I told you in the first bullet, you have an option to be governed by the provision of the Act or the treaty, whichever is more beneficial. Many a times you will come across a situation where the term royalty as well as fee for technical services is defined both in the Income Tax Act as well as the tax treaty. So which is the meaning I should go for? Now obviously, depending on the circumstances you are looking at, you would want to go for a situation where taxability may not arise. It has normally been seen that the meaning of these two terms under the Income Tax Act is very wide, which means that if you will try and see whether a particular payment is taxable as royalty or FTS under the Income Tax Act, chances are you may be covered. But then you have to see the meaning of these two terms under the applicable treaty. And if the definition under the treaty is what we call it as narrow, right? Then probably you may come in a situation where this payment may not be taxable under the treaty, and you may say that I'm not supposed to pay taxes because even though I'm taxable under the Income Tax Act, I am not taxable under the relevant treaty. The third objective of the presentation is to see the right of India or the source state to tax royalties and FTS. In every treaty, there will be one party which will be India, since we are looking at it more from an Indian perspective, and then there will be a treaty partner. Normally, a person who is a non-resident will be a resident of the treaty country, and we call that as the non-resident or the foreign state, right? India in these cases is referred to as the source state. Why source? Because the source of that income is in India. So what are the rights of India? If we look at Article 12, to tax royalty or FTS is something which we are going to see as a part of this presentation. Now, if India has a right, then the other treaty country or the treaty partner also has to have some rights. We will need to understand what are the rights of that foreign or the non-resident states to tax the royalty or FTS. Not only does the foreign country has a right, there is also an obligation on them that if India has some right to tax these royalties, because of which they have rightly applied withholding tax on these payments, then the foreign state also has an obligation to give credit for the taxes which are withheld by India. That is something which is governed by typically Article 23, which is titled as Elimination of Double Taxation, which is also forming part of this entire curriculum. In case you are looking at the isolated part or only the course relating to fee for technical services, you can come back to us for detailed discussion on that part. Now, the next part, which is crucial insofar as royalty and FTS is concerned, is that what is going to happen if the Indian party, which has to make the payment to a non-resident, accrues these royalty and FTS in their books of accounts but do not pay them. Like I told you in the first part of this, if the Act and Treaty provide different treatments, the one beneficial to the non-resident is what applies. If the Income Tax Act provides for taxation on accrual, but the treaty definition says that it is only royalty or FTS which is paid, which is taxable, how are you going to look at the tax implications not only from the perspective of the non-resident, because he has to pay tax, but also from a perspective of the payer who's accrued it but not paid it. The next one is something which you are going to see very commonly across all the articles, which is that in case this foreign party or the foreign recipient has a permanent establishment in India, right? So he is deriving some income by way of royalty or FTS, but he is also having a permanent establishment in India. Then in that case, how does the existence of a PE impacts the taxation of royalty or FTS. While this is something which we are going to discuss in great details, one thing I want to tell you very clearly over here is it's not always necessary that if you have a PE that is going to impact the taxation of royalty and FTS, which means that it's not necessary if you have PE then the taxation of royalty or FTS will be under Article 5 read with Article 7. It may still continue to be done under Article 12. When, what situation, that's something which we are going to look at. The next question, what is going to happen if the royalty or the FTS which is paid by the Indian company to the parent or to someone else is more than arm's length? Now suppose I have to pay royalty to my foreign parent for the use of brand. On an arm's length basis, it should not be more than, let's say, 5%. But I pay 7%, right? So this excess 2%, is it going to still be taxed under royalty FTS or no? The answer to that is no. But why? What is going to happen? Where else it will be taxed? That is something which we are going to look at when we go through this presentation. And last, but the most important, case laws on royalty and FTS. Now, there are more than 1,000 case laws that we have today in India on these two topics alone. Each one of them, bases the facts, bases the agreement, have resulted in interpretations which at times are difficult to reconcile. Right? Because the judiciary has to deal with so many of these things where one particular thing can be interpreted differently depending on the facts of the case. Now obviously it's not practical to cover all of them as a part of this presentation, but we have tried to capture a good number of them during the course of this presentation. If you think there are some more cases that you believe should be covered, you're most welcome to suggest them to us. So with these objectives in mind, let us now move on to the next slide to see how these are to be tackled. Let's try and see a practical situation in terms of what could be the scenarios where a royalty or an FTS may be taxable in India. Right? The first one, which is there to my left side, let me just highlight this. Now this basically, if you look at it, covers a situation where there is an Indian assessee. Okay, this Indian assessee might be making a payment to a foreign company. In present case, we've said that this foreign company is a US entity, right? So you have an Indian company which is making payment to a US company which is in the nature of royalty or fee for technical services, right? The second situation could be that this Indian company is actually making a payment of royalty or FTS to a PE which is there of the foreign company, right? And this PE might actually be there in UK, right? So we had an original company which was there in USA. There is a foreign company which is in US. There is a company which is there in India. This Indian company is making a payment of royalty or FTS to the foreign company. Alternatively, it might just be possible that this foreign company has a PE in UK to which the Indian entity is making the payment. Right? The second situation could be that there is a foreign company. In this case, if you look at it, it is FCO2, right? There is an FCO2 which is making a payment of royalty or fee for technical services to another foreign company, right? But the thing is that this payment for royalty or FTS is made in respect of an Indian business. So what we have here is that there is a foreign company 2 which has an Indian business, and in respect of this Indian business, the foreign company 2 is making a payment to foreign company 1. If I have to see the heading, what I say is that a non-resident with an Indian connection, FCO2, pays royalty or FTS to another non-resident. The question here comes up is, how do you ascertain whether a person is a non-resident or a resident? Obviously, you need to apply the meaning given under the Act to see whether the person is a resident or not. But more importantly, the residential status needs to be ascertained as per Article 4 of the relevant treaty. The reason for this is that when you look at the treaty, right, the benefit of the treaty is given to a person who is a resident of a contracting state. In this example, if the foreign company too wants to opt for the provision of the US treaty with India, they have to be a resident as per Article 4 of the India-US treaty. The number of articles may be different, right? But generally your residential status has to be ascertained as per Article 4 of the relevant treaty. So two situations. The payer is an Indian assessee. This Indian assessee could be the government. It could be an Indian company, right? The second case could be the payer is actually not an Indian assessee but a non-resident who's making payment to another non-resident in respect of an Indian business. Let us now look at what are the inter se rights of India and other contracting states in respect of payments for royalty or FTS. Now, when I say about inter se rights, what I mean is that how much withholding tax can be applied by India and how much withholding tax, or actually not withholding tax, but the tax that can be applied by the other country, right? Before we get into this, let me first understand the facts with you. Now, in this particular case, what we are looking at is there is an Indian assessee, okay, who's there in India. If you look at the black box here, he is making payment of RFTS, royalty or fee for technical services, to a foreign company, which is there in US. And there is a withholding tax of $10, which is applied by India, right? So when you talk about India, what is happening here is that a withholding tax rate is applied as per the treaty or act on a gross basis. Now, once India has applied a withholding tax rate of 10%, this amount is being received in USA by the foreign company. There's already a withholding tax of 10% which has been applied. So how would the taxation work? If you step back a little bit and think about it, in case this money is received in a US company, for them, this amount may actually be a business income, right? It's not necessary that this amount is going to be taxed on a gross basis in USA as well. So the gross amount of $100 may be taxed as business income on a net basis after deduction of expenses, right? It is just like, if you think about it, in India you have professional income, right? On that the withholding tax rate which is applied is 10%. Now for the professional who receives this money, this income is taxable on a net basis, right? So let's say if you think of a chartered accountant, if he gets 100 rupees from his client, the withholding tax is 10. But when you prepare the return of that chartered accountant, right, he claims his receipt as 100, deducts the expenses, let's say those expenses could be anything, and on the net, he still pays tax at the rate of 30%. Whatever is the withholding that has been done by the client of a chartered accountant, that is claimed as a set-off against the tax liability which he has on the net income. Similar to this, what you have is that even in US, if you just compare this, let's take a case where the expenses are $80. So your receipt was $100, your expenses are $80, your income will be how much? 100 minus 80 or 20. Since the income is $20, if the US tax rate is 35%, the tax due in US will be what? 35% of 20 or $7. Since the withholding tax in India is $10, assuming the credit is available, there will be no further tax which will be due in USA. And the reason for this is very simple. Your tax liability in US is $7. The tax which has been withheld in India is already 10, which is more than the tax payable. This $3 becomes a sunk cost to the US company unless and until that country has a rule whereby you can carry forward the foreign tax credit. But let's look at another case. Okay, in this case, let's say the expenses were $60. The income is 100, the expenses are 60, which means the income is $40. If the tax rate is 35% of 40 will be 14. So the total amount of tax which is due in US on this $100 which has been paid from India is $14. Right? Out of this 14, the withholding tax which has been applied in India is $10. Right? So if the credit for this entire 10 is available, then in that case, it's the additional $4, which is 14 minus 10, which has to be paid in US. Right? So just like in case of an Indian client, both the countries have a right to tax these payments. Right? If I have to summarize this, if on $100 India applied a withholding tax of 10 and the expenses in US is 80, whereby the tax due was 7, since 10 has been held by way of withholding taxes, no further tax needs to be paid in US. But if the income in US is $40, the tax rate is 35%, which makes the total tax payable as 14. Against this, you will get a credit of 10, and the balance $4 will need to be paid in US. In addition to this, like I said, the set-off and carry forward of foreign tax credit shall be as per the local US laws and other treaty provisions. This is basically in the context of case A, where the total tax withheld in India was 10, the tax due in US was 7, so there was 3 of taxes which was paid in India, which was more, and against which no credit was claimed.